Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Earnings showing no signs of improving, a postponed bank bailout plan, and still no stimulus. But what does it all mean? Well, that's what our panelists are hopefully here to tell us today. Senior market analyst Charles Rotblatt, value stock analyst Tracy Reinick, and Zacks top stock screener and market technician Kevin Matris, all here at the round table. Let's start with earnings, because that seems to have been one of the main focuses for the stock market anyway. In a word, disappointing, huh?
That's a good way of saying it, and a lot of people are looking at the growth rates. If we look at the numbers through Friday evening, we're looking at median growth rate for the S&P 500 of about down 7%. That equates to actually plus 12%. For the same quarter a year ago, Q4 07. But what's more telling, and I actually read the numbers, so excuse me for looking at my notes.
It's okay.
Don't have everything memorized yet.
Right.
But when you look at the number of companies growing earnings versus seeing a decrease in earnings, so even if they're profitable, they made less this quarter than a year ago. For the fourth quarter, out of the approximate 330 companies that have reported, only 136 actually have increased earnings over a year ago. This same time into earnings season last year, we saw 233 companies increase earnings. So now we're seeing more companies report a drop in earnings, far more than we did a year ago. It's not surprising given that we're in the midst of a recession, but it is pretty telling. One other anecdote I will put in there, when I do my weekly earnings preview, I usually like to highlight the number of companies that could issue a positive earnings surprise. Every week I'm finding it harder and harder. It used to be what four am I going to limit this highlight this week, and now it's like, can I even find two or three? So it's definitely tough, but we're in a recession, so it's not entirely surprising that we're seeing bad numbers and seeing fewer companies look like they're going to surprise to the upside.
So then the real question becomes, are these median estimates low enough, or is there still more room to the downside?
Well, it seems like there might be more room to the downside because we're seeing some of the estimates come down pretty sharply going forward. And, it's not even, as a value analyst, the stock market doesn't even seem that cheap right now based on what we're seeing out of this current earnings season and what the estimates are going forward. I think based on what our current valuation is, it's about 15 times 2009 earnings, which isn't that cheap for the S&P 500 relative to everything. A lot of the stocks look cheap right now because their PEs are low because the E part is plunging. So it's hard to value right now.
Right. So what does it all mean for the stock market here over the near term, Kevin?
Well, I mean, it's a very tough environment. I'm not going to make any apologies for looking at my notes, so let me look at it right now. I was looking at it right before we came on, and as of Friday, it looks like 300 companies in the S&P, or over 300 companies in the S&P, indeed have reported fourth quarter earnings. Charles already said it. Roughly 55% of them beat their earnings estimates, while only 33% missed. However, this belies the fact that roughly 65% of these companies that had reported actually lost money. Only 32 or 33% actually saw any quarter-over-quarter earnings growth. What's interesting, though, is that looking at those companies that have already reported Q4 earnings, if you were to take a look at their Q1 earnings estimate revisions, 87% of those companies have seen their earnings estimate revisions lowered over the last 4 weeks to the tune of 14.5%. So again, 87% saw their earnings estimates lowered by 14.5% as a median. So, there's a lot of difficulty out there. Nobody has any idea what's going to happen. People think that's going to be the next shoe that drops.
Well, what does that mean for the average investor who's trying to decide whether they should, consider investing in a company right now?
Well, there are some bright spots. If you were to take a look at oil production and pipeline, if you were to take a look at medical and dental supplies, schools, I think another area that's doing good is food and dairy. These companies are the companies that are seeing the most aggressive upward earnings estimate revisions, and that's really what you're going to have to focus on. Looking at companies that are anticipated to earn money, and looking at those companies where earnings estimate revisions are being raised.
What about 09? Anybody have any guesses for 09 earnings?
It's still up in the air, and the one trend we've really seen is that estimates have been cut dramatically and quickly. We've seen about 30-40% drop in the consensus estimate for S&P 500 really since the fall. And I think one of the things that's important for investors to understand is not only are we seeing estimates being revised downwards, but if you really look at where we were at just even 3 or 4 months ago, forecasts have dropped very harshly, very quickly.
All right. Well, as if that weren't bad enough, we were supposed to have a stimulus bill all put together by now. Apparently, the Senate folks weren't happy with the one that they got sent from the House. They're now working their magic on a new version, which then will have to go back to the House and waste even more time until you get a final bill that everybody can be happy with negotiated. So, and compounding that whole problem going on in Washington, a bank bailout bill that was supposed to have been presented by today, but got postponed until Tuesday the 10th because of work over the weekend on the stimulus bill.
Yeah. You know, I think happy is a relative term in Washington right now. It doesn't seem as if anybody is happy with the way the stimulus bill is taking shape. You know, when Obama got in, he was looking to have a big bipartisan bill. He was hoping to have as many as 80 senators on board from both parties, you know, Republican and Democrats. And if you look at what has happened so far, you know, the House bill passed without a single Republican voting for it. That is the antithesis of bipartisanship.
Right.
The Senate bill had to be watered down considerably, and they were only able to pick off 3 Republicans. And again, they still haven't voted on it. They have this tentative agreement. They're going to vote on it, I think, today or tomorrow, but who knows how that's going to go. But the thing that I think worries so many people right now is that when you look at the Senate bill, a lot of economists believe that the $100 billion that have been pared from that bill was some of the most stimulative parts of that bill. For instance, I think $40 billion was taken out of that bill that was going to be state aid, and most economists believe that state aid is the quickest way to get that money into the economy.
Money for education taken out
That
as
is
well.
right. But then when you look at the House bill, it is loaded with so many things that most economists believe are not stimulative, that people believe that we may be hurting ourselves as we move further into the future. So we have this.
The two arguments I'm hearing, first of all, a lot of CEOs not making any excuses, having no problem saying to the president, what's the rush? Whether we pass it this week, we pass it 2 weeks from now, maybe if you wait 2 weeks from now, you'll get a better bill out of the deal.
Right.
And second of all, everybody seems to be in agreement that there's still a lot of pork left in this bill.
Yeah.
There's plenty of pork, but I agree with what Kevin said about the states. I mean, you're starting to see a lot of state governors basically taking to the airwaves saying they must have help, and like severe help. And, you know, I don't know, there's a disconnect between what the states need and what's happening in the Congress, and to some extent a disconnect between, like you said, about the CEOs and also what's happening in the Congress about the timing.
Right.
And also they're saying about 2/3 of the actual stimulus that's going to be going for the repair the roads and the bridges and all that won't actually really start stimulating until 2010, 2011. So if you're rushing, why are you rushing if it's all going to be later? But I think something we were talking about before we went to tape that is interesting about this bill is that $15,000 credit, homeowners credit in there, which is slightly different than the $7,500 one that they had in the prior program about 6 months ago that didn't seem to do anything. But that one was for first-time home buyers only, and it had to be repaid back, actually. This one is for anyone buying a home, and it doesn't have to be a first-time home buyer. So the National Association of Realtors is really pumped about this because it's, you know, $15,000 up to $15,000 or 10% of the purchase price is a big, you know, tax deduction.
Right.
And so will that get people to go out there and start buying up a lot of this housing inventory that's sitting there? They hope. It remains to be seen because part of the problem is with the housing market, it's never rebounded actually during the recession. I mean, part of the problem is you have to have a job to go buy the house.
Right.
So
You have to have
you have
income.
these two, they're trying to pump it up at a time that normally you can't pump it up.
Right.
So bottom line, the postponement of these two bills, which are key pieces to any kind of a recovery in the economy, what does that do to postpone any kind of a bottoming that the stock market might be putting in place right now?
Well, I mean, today the market's kind of trending sideways and people are waiting to see. I think the biggest problem we saw with the bill is a lot of people in Congress saw as a catch-all, let me get this program in. Prime example is women's health. Very worthy program, but it doesn't need to be in an economic stimulus package. It needs to be something that should be discussed outside of it. So I think Congress actually bears a lot of blame for what they have out there. And I think the market, at the end of the day, if there really was a thought that we'd get a better bill out but would require waiting 2 or 3 weeks. I think people would be okay waiting for it. I think the thing right now, why you're not seeing a big reaction, is that we are getting a pork-laden bill. It has some good things in there. It has some things in there that shouldn't be in there. And I think the market's just kind of taking it in stride and realizing this is Congress. But I think what's going to have a bigger impact is after we get this bill passed and people start realizing there's a lag between we got this huge spending bill passed and we actually start seeing the benefits of it.
Still, there's a limit to the amount of optimism and the time window that the market will give this thing, too.
Right.
I mean, the market's taking news in stride. They took the bad employment numbers in stride back on Friday, the 6th. But there's got to be a limit to the market's patience as well.
Well, that's why I've said before, I think the Dow's going to fall lower, and I actually think it could hit 6,300 before we actually start seeing a firm rebound. So I do think at some point we'll see a pullback, but it's going to be a volatile year, and volatile markets mean you'll actually have some very strong rallies. You'll also have some very sharp pullbacks, and investors just need to brace for that.
All right, and all of our analysts here will be keeping their eye on latest developments, the volatility, and everything else that we've talked about here at the round table with the whole crew. I'm Terry Ruffalo.